The Fed did it again. They raised interest rates another quarter of a point. So the Fed funds target range now is 5 to 5.25.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
The Fed did it again. They raised interest rates another quarter of a point. So the Fed funds target range now is 5 to 5.25. Now remember, initially, I thought that they might not have hiked. This was a while ago. Based on the beginning of the financial crisis, I thought that might have been a catalyst for the Fed to pause. But then the Fed made it pretty clear that it wasn't going to be distracted from its mission. It never really acknowledged that this was a financial crisis, kind of like a mere bump in the road, nothing to really worry about. And so the Fed made it clear, and the markets anticipated that the Fed would, in fact, hike by 25 basis points. And that is exactly what they did. That's what I've been expecting now for the last couple of months, because I know from past experience that the Fed always does whatever the markets expect it to do. It's kind of afraid to do anything different than what the markets expect. So it waits to figure out what the markets want, and then that is exactly what it delivers. Now, I think, though, that more people were hopeful that the Fed would have stronger language that this was the last hike, that this was it, that they had reached the peak of the rate hike cycle. And I don't think the markets got that today from Powell. And that's why I think the market sold off. It didn't sell off a lot, although we'll see how much more we get tomorrow. But the Dow finished down about 275. That was the low of the day, although initially when we got the news, there was a small relief rally because the markets thought maybe the Fed was going to give them that. Of course, we hadn't had the press conference yet, because in addition to the hike, there was a small tweak to the language of the official statement. And basically, the Fed wrote that instead of it anticipating more hikes, it changed that to kind of read that it may be appropriate for there to be more hikes, but then it may not be. It's kind of depending on the data. So before, they were anticipating more hikes, and now they're not really sure what's going to happen. It just depends on what's appropriate. So that gave the markets some hope that maybe we would get something even more dovish from Powell at the press conference that came a half hour later. And that's what I'm going to spend most of the podcast on. In fact, the rest of the podcast really talking about what Powell said during this press conference, beginning with his opening remarks. And he started by addressing, I guess, what would be the elephant in the room, although there's so many elephants in this room, it's hard to, focus in on any one. I've probably never seen a room with more elephants than it's, it's like a circus at this point. But what he started off saying was that the situation in banks has improved markedly recently. Like, yes, there was a problem. There were some banks that were failing, but don't worry, right? The situation is greatly or markedly improved recently, and that the U.S. banking system is sound and resilient, right? Sound and resilient. This is what Powell said not that many hours ago. And probably a couple of hours after that statement, maybe not even that many. I'm not really sure how much time transpired between that confident statement and the next shoes that dropped. And that is another major bank, which is already having some problems if you look at the stock price. But PacWest Bancorp, after the stock market closed, and by the way, the regional banking index hit a new 52-week low today, before this news. But the news came out that PacWest Bancorp is out of money, right? They need to raise capital. They need to tap the markets. They need to sell stock and raise capital to shore up the bank because they've lost so much money. Now, the stock is trading 60% down in after-hours trading. It had already been clobbered before it lost another 60% of its value, on the way to probably losing 100% of its value, because this is exactly how Silicon Valley Bank started, right? First, it was like, oh, we need to raise some money. And the next thing they know, they're in receivership and they're gone bankrupt. Well, it's probably going to happen again to PacWest. And in fact, another bank, Western Alliance Bank, which has also been having problems, that bank is down 30% in after hours on the news from PacWest Bancorp. So they're probably going under too. I mean, I was even speculating about that prior to this. Just looking at their stock price, the markets were sniffing this out. And as the stock really starts to fall, depositors get worried, right? The big depositors who have more than $250,000 in the bank, they watch the news. A lot of these guys are probably in the stock market. They see the shares of the bank where they've got a lot of money. They see the price crashing. What do they want to do? They want to get their money out. Even if they weren't pulling their money out before the stock started to crash, once it starts crashing, you want your money. I mean, why not? Why leave it there? Why take a chance? None of these large deposits are 100% guaranteed, right? Because the deposit insurance is to $250, and the rest of it is, a crapshoot. It depends on, what they decide. Well, why take the risk? It's not expensive or difficult to just transfer your money from one of these banks where the stock is crashing to another bank where the stock is stable, or one of the bigger, too big to fail banks where you pretty much know that no matter what happens, the bank's not going to be allowed to fail. So why not just transfer your money? I mean, better safe than sorry. I mean, there's no upside to staying in a bank, once the shares start to crash. And so that's why once this snowball starts rolling down the hill, you don't stop until you get, a giant boulder and the bank fails. So these banks are probably going to fail, because if they weren't going to fail before, don't you think come tomorrow morning, the rest of the people who have their money in these banks are going to go to yank it out? Of course they are. Why wouldn't they? And then what's going to happen is that as more banks fail, then more people get worried that their bank is next. And so what do you do if you're worried that your bank might be next? You get your money, right? I said this from the beginning. In order to stop this, they are going to have to come out and explicitly guarantee all of these bank deposits. Now, of course, that is the wrong thing to do. It's two wrongs make a right. What is causing the problem is the government guarantee. None of these guarantees should exist. We shouldn't have the FDIC. Everybody is talking about now, how can we reform the FDIC to better make sure that the banks are stable? And Powell even said he wants the banking system to be more stable, even more resilient. Well, the only way to do that is to get rid of the FDIC. As long as the government is in there guaranteeing deposits, you guarantee there will never be stability. There will never be any resilience. The only way to make the banking system stable and resilient is to have capitalism, to have competition, to let the markets rein in excess risk-taking. Governments are encouraging and subsidizing excess risk-taking. That's why we have it. That's why the banking system is so unstable. But the Federal Reserve and the government don't understand the root cause of the problem, and their proposed solutions will simply take a problem that they don't understand and make it worse. But regardless of what they end up doing, no matter how many banks fail before they decide to backstop the rest, you don't want to leave your money in the bank. I've been saying this not only since this financial crisis started, which of course nobody is calling it a financial crisis. How many banks have to fail before it's officially a financial crisis? I don't know. Maybe we'll find out, because a lot more are going to fail. But as I've been saying, you want to take your money out of these banks. It doesn't matter whether it fails or not, because the money's going to fail, even if your bank doesn't. because they're going to have to print so much money. They're going to have to create so much inflation to backstop all these banks and bail them all out, because pretty much they'd all fail based on the foundation that they're on, that the Fed created, that's now crumbling. So you got to get your money out of these banks, because inflation is going to destroy its value. Even if you don't lose your money, you will lose the value of your money. The markets are starting to figure this out. Again, they haven't figured it out. So they're starting. Gold prices are up another $11 as I speak. They're at 22,051. I saw it higher. We were closer to 2060. So almost a new record high in the price of gold. Gold was up about $16 or $18 during the session today. And then it jumped up more after hours on these collapsing regional banks. But remember, in my last podcast that I did on Sunday night, right, gold was at 1,980. And I was thinking, why isn't it going up? Because there was already another bank, First Republic, that failed on Friday, and they were looking for a buyer. JP Morgan Chase, one of the banks that's too big to fail, just got even bigger by buying First Republic. But I said on that Sunday night podcast, didn't make any sense that gold was down. That was bullish for gold. And I said, try to buy it, tomorrow. And of course, it actually recovered those losses by the open on Monday, but then sold off almost back to that level before rallying. But here we are now, just a couple of days later, or 3 days later, and we are $70 higher than that. And as I've been saying, these dips below 2,000 on gold are buying opportunities. This is the floor. This is not actually just a floor. This is a launch pad, and we're getting ready for a moonshot in the price of gold, in case you haven't figured that out yet. But you need to get out of paper and into real things like gold and silver. And what's happening with the banks is just more proof that that's what you want to do. But I just, ultimate irony, I don't know if anybody in the mainstream media is going to point out how ironic it is that Powell was just talking about how, everything is improved, the worst is over, and now, more banks failing. Again, there's every time they say it's over, there's another shoe that drops. And every time they say, is this the last shoe? No. And I've been saying again, since the very beginning, that this is a centipede, right? I think that's 100 shoes, and maybe, what of them? 5, 6 of them have dropped. We got a lot of shoes that are going to drop. The only thing that's going to stop it is going to be when the government officially backstops everything. But that is going to accelerate the inflation problem because of the amount of inflation that has to be created to make good on that guarantee, because the FDIC has no money. And so where's the money going to come from to insure all these deposits that are right now not insured? It's going to come from inflation.